When severe hail batters a suburban roof, the immediate instinct is to fix the damage as fast as possible. But that sudden repair doesn't happen in a vacuum. In Murfreesboro, the median monthly housing cost for a mortgaged home already sits right around $1,900. Then a storm hits, and you are staring at a $15,000 to $20,000 estimate for a full roof replacement. Faced with a five-figure invoice, the natural reaction is to look for an immediate release valve, finding the lowest possible monthly payment to absorb the shock. Treating this strictly as a construction project ignores the financial reality. Financing a roof is a major household cash flow decision. Defaulting to whatever loan offers the smallest monthly installment, without analyzing the terms, can quietly drain your long-term wealth. Shopping for a loan based solely on the monthly payment is a common, expensive mistake. Let's look at the exact same $15,000 roof replacement financed two completely different ways. This chart shows our first option, a $15,000 balance financed over 60 months at a 9% interest rate. Now look at the right side. The same project stretched out to 84 months at 10.99%. The monthly payment drops, making it feel easier to swallow today. But watch what happens to the total borrowing cost. Because that debt is stretched over extra years at a higher rate, the total amount paid spikes due to accumulated interest. The headline price on your contractor's estimate is not your actual cost. Your actual cost is the financed total. A truly safe monthly payment has to fit comfortably alongside your mortgage, insurance, and utilities, without extending your debt longer than necessary. If your damage is storm-related, signing a financing agreement for the full contract price before the insurance claim is settled is a massive financial risk. Insurance policies typically calculate payouts in one of two ways: replacement cost coverage or actual cash value. Starting with a $10,000 roof value, a large chunk drops off for depreciation. Then your deductible is subtracted, leaving a small initial payout. That empty space is the funding gap you must bridge to get work started. Then you have to look closely at your deductible. Many modern policies no longer use flat dollar amounts for storm claims. Instead, they apply percentage-based wind and hail deductibles. A 2% wind deductible on a $400,000 home means you are responsible for $8,000 in cash before the insurance company pays a dime. Structuring your loan without calculating your specific ACV gap and your true deductible guarantees that you will overborrow and pay unnecessary interest. When you have active leaks and incoming severe weather, speed matters. Contractor-arranged financing is the most direct route. Its main advantage is workflow. You handle the estimate, the installation schedule, and the loan approval, all in a single conversation. The trade-off for that speed is restricted choice. You lose the ability to shop around, and some programs build dealer fees into the project price. If you want fast funding outside the contractor's ecosystem, the alternative is an unsecured personal loan. This option protects your property. Because the loan is unsecured, you aren't pledging your house. But that protection comes at a cost. The lender takes on more risk, which means a noticeably higher interest rate. Both options offer unmatched speed, but require you to aggressively scrutinize the APR and fees. Convenience shouldn't mutate into a long-term financial burden. For homeowners replacing a roof purely due to age, who have significant equity and a stable budget, the options change. A common tool here is a HELOC, a home equity line of credit. It acts like a revolving door of funds with a defined draw period. A HELOC is highly effective if your roof is just one phase of a broader property renovation that includes gutters, siding, or structural repairs. The danger of a HELOC is its variable interest rate. Market fluctuations can turn a manageable minimum payment today into a budget-breaking obligation later. The disciplined alternative is a fixed-rate home equity loan. It provides one lump sum, one fixed interest rate, and a defined payoff schedule. That structure aligns perfectly with a one-time expense like a roof. Both of these equity options carry a severe collateral risk. Failure to repay gives the lender the right to foreclose on your home. Leveraging equity grants access to the lowest borrowing rates available, but because your house is on the line, it demands absolute budget certainty. This chart illustrates our final framework. The right loan choice depends entirely on matching your specific situation to one of 3 borrower profiles. First is the storm scrambler. This homeowner is dealing with active damage, insurance payouts, and deductibles. This profile matches with short-term gap financing or unsecured loans. The goal is to quickly bridge the depreciation wait time without signing a 10-year note. Second is the phased renovator. They are replacing an aging roof alongside multiple other exterior property upgrades. This profile aligns with a HELOC. The flexible draw period provides the necessary cash flow across different project phases, outweighing the risk of the variable rate. Third is the equity planner. This homeowner pays entirely out of pocket for a one-time roof replacement and operates on a stable budget. The optimal match here is a fixed-rate home equity loan. It enforces maximum fiscal discipline and secures the lowest possible interest rate. Categorizing your exact profile ensures you select a financial tool that serves your long-term risk tolerance, rather than submitting to a contractor's immediate timeline. The unbreakable rule of roof financing is simple: control the balance. You must aggressively verify your true out-of-pocket number before you borrow. Navigating the intersection of ACV insurance timelines, percentage deductibles, and variable loan rates is complex. It should not be done alone. For an honest assessment and an expert financing plan tailored to your exact situation, contact Trusted Roofing Murfreesboro.